Well, thank you for that nice introduction. It's too bad that Tim didn't have a chance to go into my high school basketball career and some other highlights that I'm sure you follow very closely. But today I'm going to take a slightly different perspective. As you can see, we're going to look at three questions. First of all, why I believe that every company should have a finance committee as well as an audit committee. Usually companies don't have a finance committee. Second is, what's the key job of the finance committee? Capital allocation. I'm going to talk a little about what capital allocation means. And third of all, I'm going to focus on what I believe is the most important question for companies now in terms of long-term versus short-term is what we've seen in the last few years in terms of share repurchases. So let me begin by just listing all the things that have to be done by the audit committee. And my argument for a finance committee, and I do chair the finance committee at Medtronic, is that the audit committee is overwhelmed by SOX, Dodd-Frank, lots of detail, and they never can get to the important questions. I was on the audit committee of several different companies, and we never got to capital allocation. We never got to tax planning. We never got to many of the most important issues because we were weighed down by this list. And then at the end of the audit committee, now every good audit committee has a private session in which there is a very long line outside the committee for the CFO, the compliance head, internal audit, external audit. And so, you know, it's a 3-hour meeting without ever having looked at the key issues, the key overall macro issues for a company, in my opinion. So this is what a finance committee does. And you'll see some companies have a risk committee that's really quite different. Risk committees are in banks and other financial institutions. They're basically a way to try to, they're really compliance committees. But here we have what the finance committee at Medtronic does, and I think it's really important. We review major acquisitions, including post reviews to see whether they worked out. We review and approve capital expenditures. We approve debt issuance. We get involved with tax strategy, which these days is almost a full-time job. We approve pension insurance plans. We look at management of cash and currency. Currency, as we all know, is a big deal in terms of companies' earnings. And most importantly, we focus on the allocation of capital. Now, the allocation of capital, it seems to me, is at the core of the question we've been discussing about the relationship between boards and shareholders. Because management has a number of choices. They have profits, and so a company like IBM, what are they going to do with the profits? They have two basic choices. They can reinvest in the company, or they can distribute to shareholders. So what types of reinvestments can they make? Well, they can do internal expenditures, especially R&D, to innovate, to produce growth internally. They can make external acquisitions, either what we call bolt-on smaller acquisitions or big acquisitions, and they can reduce the debt load, which is sometimes used to finance these acquisitions. Or alternatively, they can distribute to shareholders either quarterly dividends or share buybacks. Now, this slide gives you what Medtronic's long-term plan is. And I was somewhat amused by the discussion about shareholder engagement. Since I'm an independent director, I'm not the non-executive chair of the board of Medtronic, and so I was told that I had to give you the exact slide that our CEO had used at the JP Morgan conference. And I think this is a big issue. As an independent director, you don't really feel free to speak on half the board. You can speak in your own half. And that's why I believe now there's a different, somewhat different case, new argument for a non-executive chair, is that the non-executive chair can be the legitimate representative of the board in talking with shareholders. When I was a CEO, I didn't like the idea of lots of my directors going around talking to people. Who knows whether they were actually going to say the same thing. So having a non-executive chair, and some people argue for it, some people argue against it, but I think there's a new argument now in terms of shareholder engagement. In any case, you can see here that Medtronic has said that it's going to aim at mid-single digit constant currency revenue growth. And that comes from three strategies. One is therapy innovation, second is globalization, and third is optimizing cost and efficiency in the healthcare system. The second commitment is to double-digit EPS growth, relatively low double digits, I should say, and they achieve that by improving their operating margins and using some financial leverage. And the last thing is we have a public commitment to give back to shareholders 50% of the free cash flow. Now, looking at that last thing, you can see that there is this chart here showing you roughly how things go, and Medtronic generates free cash flow of somewhere between $5 and $6 billion in the current fiscal year. And we are committed publicly to a dividend that's 40% of free cash flow. Well, we're proud to say that we have increased our dividend every year for the last 38 years. Then we do reinvestment, which can involve debt paydown. We did a large acquisition of Covidien, and we want to make sure that we maintain our A rating. And we also do tuck-in acquisitions. And then finally, lower down, we have share repurchases. And that's what I really want to focus on today, because I know from talking to a number of CEOs here that they feel under a lot of pressure to do a lot of share repurchases, and the statistics sort of show that. So here is the first chart that says, if you look at all of shareholder distributions, and they include dividends and they also include share repurchases, they substantially exceed the net income of companies over the last 4 or 5 years. Now, when you think about that, that's a fairly amazing statement, because we're saying that on average, companies are distributing to shareholders more than they're actually earning. So if we want to see that a little more clearly, we can see it in this chart. We look at share buybacks and share issuance and we can see that in 2008 through 2010, there was a big dip in share repurchases related to the financial crisis. I also remind you that that's when share prices were low. But as share prices have gotten higher and companies have felt better about their situation, they have increased their share buybacks. Now, this is probably the most important chart, and that is, how is this being done? How is it feasible for a company to distribute more than its earnings? And the answer is quite simple. Debt has been very cheap, and so we see a huge amount of debt issued for the main purpose of buying back shares. How much? In the period here, 2010 to the end of 2016, we had a little over 600 billion. So this is a real phenomena. You could argue that maybe we're having this tremendous increase in earnings, the growth in earnings, and that's why we're having all these buybacks, but it turns out not to be true. To the contrary, since we are not seeing this big increase in earnings over the last 3 or 4 years, we are financing share repurchases by going to the debt markets and issuing cheap debt. Now, the question is this good or bad for companies? And people have spent a lot of time on this question, and I think a fair statement is that when you do a share buyback, you essentially keep the same level of earnings, but you now have those earnings spread among a smaller number of shares. So therefore, your earnings per share goes up. I think this is true. Even at MIT, I think we can figure this one out. But the key is to understand that earnings haven't gone up. Earnings haven't gone up. This is not a sign of growth. This is a sign, some people would say, beyond a certain level of financial engineering. Now, every company, I think, should have some level of buybacks. And for instance, companies have employee share programs, share option programs. That's a perfectly legitimate reason to have share buybacks. And having things where you buy back 10, 15% of your free cash flow, that's a perfectly acceptable number. Perhaps if you have a very big divestiture and you're not sure what to do with all the capital, you might give some money back to the shareholders. So what we're really saying is when we have these profits, we have to understand and really focus as a board of directors as to what's the best use of this money. Do we have growth opportunities, either internally or externally, or are we just going to give the money back to shareholders? And so what we usually see is a short-term pop in the stock for several months, but over longer periods, companies that do a lot of buybacks, their stock lags the indexes. And you can see from this chart that the companies that did no buybacks over this period of time, from 2011 to 2016, that this period of time, those companies, their stock price exceeded that of the S&P 500. But if you look at the top 100 buyer backers, if that's a word, that their stock underperformed the stock market. And I think this is a very important chart because many CEOs have told me that they are under pressure from their shareholders to buy back stock. Now, I think we have to distinguish three situations. One is, as I said, there's sort of a normal level of stock buybacks that's perfectly legitimate. Second of all, if you have a special event like a big divestiture, that would be another situation where buybacks may very well be justified. But in the normal course, to be doing these huge buybacks, especially when you're borrowing, is really a sign that you have no really good growth opportunities. You have no really good internal growth or external growth. So it's a sign when we talk about long-term value creation, this is sort of the opposite of long-term value creation because you're really saying that you can't think of better stuff to do to improve your company. And I think shareholders have caught on to this, that this is just a form of financial engineering, and it's good for a short period of time. Now, the question is, are institutional investors going to get focused on this? A little while back, we had a guy named Harry Wilson who represented a number of hedge funds. He went after General Motors, and he was able to convince the board to buy back with the cash $5 billion, take $5 billion of cash and buy back stock. Now, it's hard to think of a company where buyback of $5 billion would be less consistent with long-term growth than General Motors. We know it's a very cyclical industry. In fact, it was bankrupt a few years ago. So is it a really good idea for long-term growth to buy back $5 billion of shares already? That was above their existing program. And to me, the critical thing was, did the board consult the big shareholders? did the shareholders have a role in here in thinking about whether this was long-term growth or whether this was just a capitulation to some activist? And as far as I can see, there wasn't a lot of consultation with shareholders. There surely wasn't a shareholder vote. And I notice now that T. Rowe Price, I saw someone from T. Rowe Price and other investors have now started to say to these boards, before you decide, especially under pressure from an activist shareholder, to do a big buyback, shouldn't you be consulting us and explaining your situation and deciding whether or not this is really good long-term growth for the company? Now, I'd like to dissect this a little more and just give you a few more points. One is that in the last 12 years, share buybacks have reduced the share count by 25%, but have increased EPS by only 12%. Now, this is another MIT mathematical problem. Does somebody want to solve it for me here in the audience? Here's the answer. Companies are really bad at figuring out when to buy their own stock. I would say they are almost contraindicators, meaning that when a company is buying back very little stock, like in 2009, 2010, that's when the stock was very low. When the stock got higher, then the company is buying back more stock. So perhaps this should be a new buy-side analytic tool to see whatever the company is buying back and then to do the opposite. Now, the second thing, which is a very subtle point where I was educated by some very good consulting groups, one of which I want to put in a plug for them, a strategy group that's listed here. Let's see what they're, I want to make sure I get their name right, Absolute Strategy Research. They point out that now we have such a big index fund ownership in the S&P 500. So some people had estimated 30 or 40%. What happens when a company does a share buyback? The S&P index funds are all calibrated by the weight of the stock, the value of the stock relative to the index. When you buy back stock, a lot of stock, you're essentially decreasing the percentage of the S&P 500 that your company has. And every index fund effectively must sell your stock. They must sell it because now it's a smaller percent of the index, and they then take that money and spread it over other stocks. So that's another reason why people feel we don't get a long-term stock boost. Higher EPS and lower growth, I think I've talked about that. Some people would say that the continuation of very high levels of buybacks, debt finance, really is an indication that a company doesn't have good growth possibilities. And then we've, from time to time, seen abuses where companies' CEO had EPS targets that they weren't going to make, and then, automatically, there's a big buyback just before the end of the year, and somehow they then make the target by 1 cent. It's a miracle. So, what can we say here? We can say that every board, in my view, needs not just, a lot of boards just have a nominating governance committee, a compensation committee, an audit committee, and they all need them. But I think companies really need a finance committee to focus on capital allocation, dividend policy, repurchase policy, tax strategies, et cetera. And essentially, that's where the board has to come to grips with the question, are we going to give money back to shareholders, and how much? And how much are we going to reinvest, and where? So I don't want people to think that repurchases are all bad. They're not. Like Aristotle said, everything done in moderation is reasonable. But when you start buying back over 100% of your earnings by issuing debt, there is a good argument to say that you've really sent a big signal that you don't have good growth opportunities. And while you may get a short-term pop in the stock, I believe it will not help you in the long term, and that's what we are trying to promote here. So I'm going to stop here and take questions. just as Tim told me to, and Tim will be the MC.
Thank you, Bob. So, thank you. We all appreciate your insight, Bob. Now, I know there's a whole bunch of your former students from Harvard and MIT here, some of your colleagues at all the places you've worked. So we have about 8 or 9 minutes for questions. Who wants to go first? Questions for Bob. Go ahead, all the way at the end. Go ahead, Alan. Yes, thank you.
Alan White. Thanks, Bob, for that. I'm interested in the current climate where there is a great pressure to distribute wealth within corporations to employees through stock options, through employee ownership, through cooperatives and so forth as a way of reducing disparities. In your experience, and does the data show that the tendency toward buybacks where employees are strongly represented as owners, is it greater or less?
Well, I think employees, like everyone else, should have a long-term interest in a good stock price over a series of years. And I'm in favor of stock option plans and restricted share plans that don't allow people, as soon as they vest, just to blow out the stock. Because in that case, they don't have a long-term interest. To the contrary, they have an interest in sort of peaking the stock and then getting out. So under my approach, when there's vesting, we'd allow company executives and other people to sell, say, half the stock, and they'd have to keep the other half. And they're going to want a good long price because they're not going to be able to sell the other half under my approach until they retire or 10 years or something like that. And as I said, I think that you'll get a short-term pop in the EPS with a buyback, but if you consistently are doing these very large buybacks, it will hurt your stock over time. And employees won't like that, just like senior executives won't.
Thanks. Yes, over here.
Martin Reeves, BCG. I wonder, do you think that for large corporations, the problem here is a simple rational adjustment to the absence of growth opportunities in the economy, or do you think that actually it's a failure to self-disrupt and actually we're seeing the investment opportunities being taken up by, say, smaller and more disruptive companies?
Well, it's a good question, and it's hard to tell. There are lots of, I've been at conferences where large banks would say that they would love to grow more of their loan book, but there aren't enough good borrowers. And then the borrowers stand up and say, well, there are lots of good borrowers, and we just can't get loans now. So I think it's sort of case by case. So if a company really has no growth opportunities, then it probably is better off giving back the profits. Not to borrow to do that, but at least giving back most of the profits. But if a company really has no good long-term growth opportunities, then maybe the board needs to look for a different management and see, what is this company's future? Maybe it ought to be merged into something. Maybe it ought to acquire some new business. So do we really want a company that goes on for year after year with no long-term growth opportunities? I don't think so.
Thanks. Another question for Bob. Yes, right here. Thanks, Adrian.
Hi, Bob. Adrian Monley from Vanguard. How are you?
Hi, how you doing?
Great. I'm wondering if we take it back to the board level, can you give us a sense for why you think more boards aren't implementing finance committees? And let's say a board wants to take a different path. What other structures do you think work well to sort of get to these same issues?
Well, I think it's just sort of been traditional that there are 3 committees on boards. But I think most people here who serve on boards realize that one of the big trends in the last 5 years is that more and more work is done at the committee level. And I think, you don't have to call it the Finance Committee. You could call it the Capital Allocation Committee or something like that. Or you could presumably have full board meetings if it was a small board in which they did this. But the critical question is to have either at a committee level or at a strategic session for the whole board in which these issues are front and center. Lots of companies, it's just the dividend resolution comes, they just pass it. And people are afraid to lower their dividend because they really get penalized. But repurchases are viewed as totally discretionary and done whenever management thinks it's okay. And that's what the board needs to think about hard. That money can be used for a variety of different purposes. And a good board will say, let's see, we meet our dividend obligations. We have X more for profits. Let's see, what are the internal R&D projects? What are the bolt-on acquisitions? Let's look at them systematically and see what's the best path to go. A finance committee is an easy way to do it, but if it's done at the whole board strategy session, I'm not against it. Or if we want to call it the Alpha Sigma Committee, that's okay with me. I don't get very hung up on titles.
Thanks, Adrian. Any more? We have time for one or two more questions for Bob. Anyone else? Over here in the back, please.
Hi, Bob. It's Mike Lipper. It's
Glad to see you.
You taught not only a lot of people at Fidelity, but you taught all us who provided services to it, and for which I thank you.
You're welcome.
I happen to sit on a business and finance committee, one of 3 at Caltech. My impression is most universities don't have a finance committee that looks at the capital allocation. And I would suggest, and this is heresy in academia, that one of the issues is how do you finance tenure?
Well, that definitely is a big one. I wouldn't be very popular at MIT with that, but I'm not trying to get tenure. But I do think the question for university is similar in that you have all this tuition, you have government monies that come in, you have an endowment, you have a return, and then you got to decide how to allocate that. How much should go to financial aid, how much should go to new buildings, how much should go to various things. And I'm personally amazed by how good the food is at universities that I go to. So somebody's spending a lot of money on those kitchens, because I remember when I was at college, the food was terrible. So maybe that's a good use of money to get some better students. I'm not sure.
Well, thanks.
Let me just end by
Bob.
saying one thing about repurchases. I actually think we're at a very important point here. And if we look at what are repurchases of shares going to look like in 2017 and 2018, I think it's highly dependent on what the Trump administration does. If the Trump administration comes forth with lots of private partnerships, private-public partnerships, with lots of infrastructure projects, well, that may be a good use of capital for a lot of companies. On the other hand, if, and this may also happen, hopefully, that the Trump administration will pass a tax bill that will allow some of this foreign profits that's been deferred and kept abroad to be brought back, then we will have the question, like we had in 2004, how much of that money will go into research, will go into technology, or how much of that will be going back to shareholders of repurchase. So I do think now we are really at a turning point here with repurchases. The repurchase rate has actually gone down in the second half of 2016, but it could go way up if the tax bill passes in the form I just mentioned, or it could go down if there are lots of new investment opportunities. So thank you, Tim, and I am ending right on time.